Markets come into Wednesday grappling with an increasingly challenging combination of heightened geopolitical tensions, renewed inflation concerns, and a pivotal U.S. inflation report that could shape expectations for the Federal Reserve. The latest escalation between the United States and Iran marks the most significant direct military exchange since the conflict began earlier this year, with Tehran expanding its response beyond the Strait of Hormuz to target U.S. assets across the region. Despite the significance of the developments, financial markets have so far avoided a disorderly risk off reaction, suggesting investors still believe diplomatic channels remain open and that a broader regional conflict can be avoided. Nevertheless, the risk of further disruption to global energy supplies remains the dominant geopolitical theme and continues to cast a shadow over the inflation outlook. In FX, the dollar remains broadly supported by a combination of geopolitical uncertainty, resilient U.S. economic data, and expectations the Fed will maintain a cautious stance, while the yen stays under pressure near intervention territory and European currencies trade defensively ahead of the US CPI release. In equities, US index futures are relatively steady after another volatile session on Wall Street, reflecting a market that remains reluctant to abandon the broader risk-positive narrative despite rising geopolitical and inflation risks. In commodities, oil prices remain elevated amid concerns over Middle East supply disruptions and persistent U.S. inventory drawdowns, while gold continues to find support from safe haven demand and uncertainty surrounding the inflation outlook. The focus now shifts squarely to today's US CPI report, where investors will be watching closely for signs that higher energy costs are feeding into the broader price pressures across the economy. Following last week's stronger than expected US employment data, an upside inflation surprise would reinforce expectations the Fed may need to keep policy restrictive for longer, while even a softer reading may struggle to materially shift the outlook unless accompanied by a meaningful easing in geopolitical tensions. For now, markets remain caught between confidence in the underlying strength of the global economy and growing concern that geopolitical developments could once again reshape the macro landscape. That's all for now.